Recently, President Donald Trump announced that he will be directing the federal government to purchase $200 billion of mortgage-backed securities as a part of a plan to drive down housing costs. In this video, we'll break down what's happening, why it's happening, and how this could impact you and the overall economy and as a homeowner. From understanding what mortgage-backed securities are to the potential impact on mortgage interest rates, home prices, etc., we have a lot to cover in this video, so let's get into it. First, what exactly are mortgage-backed securities? In simple terms, an MBS is a bundle of home loans that are packaged into a bond-like investment. Imagine a bank funds a bunch of home loans, and instead of waiting the 30-year term for that homeowner to pay off the interest over the long term, instead, that bank can sell off that loan to agencies like Fannie Mae or Freddie Mac. Those agencies then package the loans into securities or MBS and then sell those off to investors. This frees up cash for banks to lend more money for more home loans, increasing the supply of mortgage credit and holding down interest rates. In other words, mortgage-backed securities are a way to connect homeowners with investors. The homeowner's monthly mortgage payments ultimately go to the investors. However, the upfront money from the investors help more people get mortgages. Now, on to the big news. In January 2026, President Trump announced on social media that because Fannie Mae and Freddie Mac have, in his words, $200 billion in cash, he is instructing my representatives to buy $200 billion in mortgage bonds. The goal, as he says, this will drive mortgage rates down, monthly payments down, and make the cost of owning a home more affordable. The president is essentially ordering a massive buy-up of mortgage-backed securities in hopes of nudging mortgage interest rates lower and easing Americans' monthly mortgage payment. But who exactly will do this buying? Initially, Trump's post was a bit vague, referring to his representatives. However, shortly after, Bill Pulte, who is a housing investor turned official, who's now director of the Federal Housing Finance Agency, which oversees Fannie and Freddie, confirmed on X that Fannie and Freddie are the entities that will do the purchasing. In a reply to Trump, Pulte even said, "We are on it, Mr. President," indicating that these two mortgage giants would carry out the plan. So the buyers will be Fannie Mae and Freddie Mac, which have been under government conservatorship since the 2008 financial crisis and thus effectively government controlled. It's important to note who is involved in this plan and who isn't. Fannie Mae and Freddie Mac are the central players in carrying out the $200 billion MBS purchase. They operate under the Federal Housing Finance Agency, which is currently led by Bill Pulte, a close Trump ally. By contrast, two institutions that are not directly involved are the Federal Reserve and the U.S. Treasury Department. This isn't the Fed printing money for a quantitative easing program, and it's not Treasury spending taxpayer dollars. In fact, Pulte explicitly stated the Fed and the Treasury Department would play no role in this round of MBS buying. Instead, the funding will come from Fannie and Freddie's own balance sheets, their cash, and other liquid assets. That raises a question. Does Fannie and Freddie have $200 billion in spare cash lying around? Not exactly in cash under the mattress. Their combined cash on hand was less than $17 billion in the fall. However, Pulte insists that they have ample liquidity when you include other assets that can be quickly converted to cash. In fact, each of the two firms reportedly has on the order of $90 to $100 billion in readily available funds when counting things like short-term securities and repos. By utilizing those resources, which comes from years of retained earnings and reserves while under government control, Fannie and Freddie can fund this bond buying spree without a new congressional spending bill. In short, the government entities involved are Fannie Mae and Freddie Mac via the FHFA under the orders of President Trump. The Fed and the Treasury are staying on the sidelines for this one, which is a notable difference from past interventions. So why is the administration taking this step now? The simple answer: housing affordability has become a huge concern both for the public and the politicians. Mortgage rates have roughly doubled in the past few years, from the 3% range during the pandemic to 7% last year. Now we're trending closer to 6%. Higher interest rates means higher monthly payments, pricing many home buyers out of the market. Meanwhile, home prices remain elevated after the surge that we saw, especially this past 5 years, and the supply of homes for sale is unusually tight. Together, this has made the dream of owning a home slip out of reach for many families, especially first-time buyers. With a critical election year coming with the midterms in 2026, the Trump administration is facing pressure to show action on the cost of living, with housing front and center. President Trump positioned this MBS buying plan as a way to directly tackle mortgage costs and put a dent in those high rates. In essence, it's an attempt at a government-driven interest rate reduction for home loans. The logic is that if a big player such as Fannie Mae or Freddie Mac under government orders suddenly buys up a ton of mortgage bonds, it will boost their prices and push down yields. And because mortgage bond yields correlate directly with mortgage interest rates, new loans should become a bit cheaper for borrowers. As Trump summed it up, the purchases will drive mortgage rates down, monthly payments down, and make home ownership more affordable. There's also a historical rationale behind this move. In times of crisis, the government, often via the Federal Reserve, has bought MBS to stabilize the housing market. During the 2008 financial crisis and the subsequent recession, and again during the COVID-19 pandemic, pandemic, the Federal Reserve launched massive bond buying programs known as quantitative easing that included mortgage-backed securities. For instance, the Fed's intervention back during the pandemic drove interest rates to record lows near 3%, sparking a refinance boom and helping the housing market recover. Now, however, the Fed has been pulling back. It stopped buying mortgage-backed securities and has even been letting its $2.7 trillion mortgage-backed security portfolio shrink down to roughly $2 trillion now through the runoff. That retreat has left a void in demand for mortgage bonds, contributing to higher spreads and rates. Housing advocates have been warning of a secular and structural decline in demand for mortgage-backed securities as the Fed steps away. In fact, a group of community lenders wrote to the administration in late 2025 urging bold action. They proposed letting Fannie Mae and Freddie Mac buy up to $300 billion in mortgage-backed securities each when mortgage spreads get unusually wide. They argue this could narrow the gap between mortgage rates and Treasury yields and potentially cut mortgage rates by 0.3% or more. It seems the Trump administration took note of these suggestions. The $200 billion purchase plan is a similar kind of shock absorber strategy, meant to prop up mortgage-backed security demand and ease mortgage rates at a time when private investors and the Fed aren't doing it. Politically, housing affordability has become a hot issue and a key part of Trump's agenda in his second term. Alongside the MBS purchase, he's also floated other ideas, for example, banning large institutional investors from buying single-family homes to stop them from crowding out regular home buyers, possibly introducing a 50-year mortgage to lower monthly payments, and even helping buyers tap into retirement accounts for down payments. The MBS purchase fits into this broader push. It's one lever to make mortgages a bit cheaper, complementing other efforts to boost supply, like urging home builders to build more or curb speculative demand. In short, the rationale is both economic, stimulating the weak housing market and lowering borrowing costs, and political, showing voters concrete action on an issue that they care about. Let's talk about the potential impact on mortgage rates, since that's the primary goal. How much could a $200 billion purchase move the needle? Well, opinions vary. First off, Redfin's head of economics noted that compared to the Fed's huge bond purchases in the past, $200 billion is relatively modest and likely to only have a small impact on mortgage rates. Zhao estimated maybe a 10 to 15 basis point reduction, which is 0.1% to 0.15% in typical mortgage rates. For example, if rates were around 6.3%, they might fall to roughly 6.15%. On the other hand, Daryl Fairweather, chief economist of Redfin, suggested that the drop could be a bit larger, perhaps 0.25 to 0.5 percentage points. This could mean turning a 6.5% 30-year fixed mortgage into a 6% interest rate. This certainly isn't nothing, but it certainly won't bring back the ultra-low interest rates that we saw during the pandemic. So why would this have only a limited effect? One reason is the sheer size of the US mortgage market. There's over $21 trillion in outstanding mortgage debt out there. So $200 billion, while certainly large on paper, is less than 1% of the total mortgage market. It's a bit like a booster shot, helpful but not a game changer by itself. Fairweather called the plan a band-aid on a deeper issue, cautioning that it probably wouldn't lower rates enough to undo the mortgage rate lock-in effect. That refers to the situation where millions of homeowners are locked into their 3% interest rates they got back in 2020, 2021. They're reluctant to sell and give that 3% interest rate up, which leads to lower inventory. Tiny dip from say 6.3% to 6% might not be enough to entice those folks to sell and really increase inventory. In fact, Fairweather noted that even as we saw rates decrease from 7% to closer to 6% over the past year or so, housing demand and sales volume have only seen a minimal uptick. Another factor for would-be buyers is that home prices are actually a bigger barrier currently than interest rates. Even if you shave a quarter point off of a mortgage rate, a house that's say $400,000 is still $400,000, and prices haven't fallen much because inventory is so tight. Economists warn that if this plan actually does succeed in driving down mortgage rates a touch, it could actually stimulate higher buyer demand, and if we don't see supply increase, that could lead to higher prices, ironically offsetting the benefit of the lower rates. In other words, cheaper mortgages could intensify the competition for the too few homes on the market, potentially worsening affordability in terms of purchase prices in the long run. This is a catch-22 in housing policy. What helps buyers in one aspect could help them in another if the underlying supply issues aren't addressed. The Trump administration's $200 billion mortgage bond buying plan is a bold and unusual step, a sort of mini version of quantitative easing that is aimed at targeting Main Street instead of Wall Street. It shows how pressing the housing affordability crisis has become, that a sitting president is essentially saying, if the Fed isn't going to cut rates, I'll find a way to do so anyways. In the coming months, we'll see if this plan actually moves forward and how much exactly it moves the needle. Will mortgage rates meaningfully drop, giving some relief to homebuyers? Will home prices stabilize or even soften as we see more people willing to sell? Or will they surge because of renewed demand? And how will this gamble play out out for Fannie Mae and Freddie Mac, the once troubled giants now being asked to save the day. Only time will tell if this $200 billion bet pays off by easing the squeeze on homeowners and buyers, or if it ends up as merely a short-term boost with long-term side effects that weren't intended. If you found this video helpful, make sure to hit the like button and subscribe to this channel for more content like this. And if you're considering a home purchase or refinance in 2026, make sure to reach out in the link in the description of this video, and I'll see you in the next one.